With Brent hitting almost $80 a barrel and US crude, WTI closing in on 72, both at highs not seen since November 2014. Where now? Is the long trade over for the time being? Well, Angelos Damaskos, who runs the Junior Oils Trust, joins us now with some analysis of this. I want to talk about your fund in just a minute, but I want to talk about the oil price first of all. What's been pushing it up to these levels that we've not seen, as I said, since the back end of 2014?
Yes, Jeremy, you mentioned WTI hitting $72. Of course, Brent, which is the more internationally used benchmark for many qualities of crude, is now near $80 a barrel. And that's the benchmark that most traders are watching very carefully because, of course, it corresponds to European, Asian, and African crudes, as well as Latin America. And in our assessment, there is clearly an undersupplied market. In reaction to the OPEC cuts, as well as the dramatic cuts of capital expenditure across the industry, there has been a global decline in production from the most mature fields, and that is notwithstanding the very rapid growth in supply we have witnessed from North America. I think this is the fundamental factor pushing the oil prices higher. Now, recently, of course, we've had the market's reaction to President Trump and the American potential sanctions on Iran that could remove another potentially 500,000 barrels per day of supply from the market. So as we are facing an already short supplied market, that could further exacerbate the situation and could push prices significantly higher.
Well, let's take a look at a chart that sort of illustrates this quite neatly. And in fact, if we bring up the chart showing the inventory days of supply, this is calculated by the Dallas Fed, the Reserve Bank of Dallas. Explain what's going on here, because clearly you can see here that this low point, in fact, I think if you drew a line across there, it is actually below the point it was at in 2013.
Yes, as they say, a picture tells 1,000 words, Jeremy, and I've brought this chart up because it shows clearly how the oversupplied market of 2014 to 2016 caused a collapse in oil prices during that period and the massive bear market, and how since late 2016 we have seen a dramatic drawdown in inventories. And what this picture shows is the 5-year moving average, which is the zero axis, and then how many days from the 5-year average we deviate. At the moment, you see we are well below this 5-year average, so it's the equivalent, if you like, of one's car running into reserve, and the potential worry that draws to the market. It is, in our assessment, this is clearly the result of the dramatic cuts of capital expenditure, as I explained earlier, and the natural decline of production from the mature fields where there is significant additional investment required to maintain their production capacity. So even though North American production has grown very quickly and very significantly, it has still not been able to offset the global declines of mature fields.
What about the crude oil production capacity? How much capacity is there to make up this shortfall? We hear a lot about the fact that OPEC, and indeed Russia as well in this agreement, they're restricting supply in order to push the price up. Some would say they've already done their job. Why are they now waiting to bring extra supply onto the market? What about production capacity? How much capacity is there in the market to get us over this shortfall?
Yeah. Well, that is the very important question that most market participants are pondering. And the question is also to do with what sort of oil price the OPEC might like to see in the medium term. And the general feeling is that OPEC would like to see oil prices to trade, at least for Brent, well above $80 per barrel, because that is the figure that more or less balances their fiscal budget. But if we look at the hard facts, and that's a very interesting chart that is produced by one of the most reputable agencies, the Energy Information Administration of America, it shows how the surplus capacity of the entire OPEC syndicate has been declining since 2017, and that is after the quotas were imposed. And that takes into account factors, for example, of disruption in supply from countries like Venezuela and Angola that are in serious economic problems, and therefore are not able to arrest this decline in their capacity. And we see that they expect that by 2019, the surplus capacity is merely above 1.2 million barrels per day. Now, that does not even include the potential impact of the US sanctions on Iran that could remove another 500,000 barrels of oil per day. And of course, the impact of that will be seen in the next few months as these sanctions are fully factored into the marketplace. So even if the stronger OPEC members, essentially Saudi Arabia, decided to increase their production and tap into this reserve capacity to balance the market, they would still leave the market in a very, very tightly supplied situation and subject and prone to any further disruptions and any further geopolitical risks that might arise.
What about the demand side of the equation then? The demand seems to be certainly picking up. To what level is this picking up against previous years?
Well, that is why we see such a huge draw in inventories at the moment, because demand has continued to trade well above 1.5 million barrels of oil per day growth. And as we have discussed before, this growth comes almost exclusively from the industrializing Asian countries of China and India. And it is, according to most estimates, we have seen the strongest demand growth for the last few years since the 1970s, and it is unlikely that this demand is going to slow down. So we see a tightly supplied market with potential severe disruptions, balanced with a very strong growing demand side that continues to need more oil, and that is the recipe for much higher prices.
Talking about prices, when we last met 5 or 6 weeks ago, you were talking then about your target for $80 a barrel. Here we are now, Brent, just fractionally below that, I think, as we went into the interview. What are your projections now for the rest of 2018? Here we are now sitting, the second week of May?
Well, when we discussed about the prices, Jeremy, the last time, we were speculating about the American impact on Iran and the potential sanctions imposed on it. Now that this has become a fact, we know that there is going to be something imposed on Iran that will have an impact for up to 500,000 barrels of oil per day. So we have raised our target now to $90 per barrel for this year. And let's see what brings for next year. We think that we could well see $100 per barrel and possibly higher.
One final question is, what does this mean for you as a fund manager? You manage this Junior Oils Trust, predominantly smaller companies, aren't they? What does it mean to you? What are you looking at in terms of opportunities now at $80, $90 a barrel?
Well, clearly it is very exciting times and very positive outlook for all oil-producing companies. So what I believe has happened in the marketplace is that investors have been taken by surprise, because very few people expected oil prices to rise so quickly and so dramatically, and have rushed into the oil majors as a reaction, which are the most liquid names, the better known names. And these have outperformed, including the larger mid-cap companies. So the smaller companies have started recently to catch the attention of the market, and I think it is still early days. We know that small caps generally outperform their larger cap peers in a bull market period. So if we are right in our assessment that this oil price environment is likely to drive to higher levels consistently over the next couple of years, our portfolio should be very well placed to benefit from it.
Good. Okay, well, look, thanks indeed for joining us, and best of luck. Thanks indeed. That's Angelos Damaskos, looking at opportunities in the small cap and small mid cap space in the oil sector as a result of $80, possibly $90 a barrel in 2018. That was Angelos Damaskos from the Junior Oils Trust. Subscribe to IG for educational content, company insight, financial analysis and expert commentary.